All right. Hope you guys had a good week. This is Friday. Today is the 19th. The market closed about a half an hour ago, and I wanted to do a real quick lesson on a trade here, and on a couple of the studies. So real quick, today I just posted that my YHOO position closed for 50% of max profit. So what I wanted to do is I kind of wanted to walk you through a trade real quick. So on August 22nd, which was a Friday, I saw that the ivory rank was greater than 50 in YHOO. Okay, so I put in an order to collect over 20% of the expected move. But on Friday, I wasn't filled it. I wasn't filled yet. So on Monday, I redid it again, and I was able to collect 83 cents. Okay, so that's this is what the position looked like. All right, and I think I can go back and show you what I did here. Yeah, I sold the 32 put and I sold the 45 call. So I was betting that the stock would stay above 32 and below $45. Okay. And oh yeah, I didn't. I'll go back to that real quick. So my max profit is $101 and my max loss was supposedly $8.99, right? So I also put in a good to cancel order on that one as well, meaning I didn't, and I'll show you that right here. Okay. So here's what happened. See, on the 25th, it got filled at when the market was open, 6:30 Pacific. So, you know, here we go. I got 83 cents for it. Okay. Now, what I want to show you is the chart on this as well. So remember August 25th. So see down here's a date, August 25th. Here's where YHOO was. Okay. And IV, look where IV rank was at that time. Well, for the fifth, and well, yeah, I mean, depending where you want to open, but it closed, and IV rank was right here. Okay, so it was at 73.52, above 50%, and I was able to collect 20% of the expected move. Okay, now I also want to bring up this other chart. I'm going to go to here. All right, so I showed you that. I let you folks know I got filled at 83 cents, and then I want to show you this real quick. Remember my favorite slides? I'll go to Golden Gecko real quick, go to my favorite slides. All right, I want you folks to take a look at this chart right here. I have it taped up to my screen here. Should it stay or should I go? It should be the same one. 40, here we go. No, there we go. Okay, so see where it says up, this is your time frame, your goal list, right? Like look, I figured in 19 days I should have about 50% profit, right? So if I was at 50% profit below and it was before 19 days, I should definitely take it. In this case, I believe I put a good to cancel order. So as soon as I hit 50% of max profit, it would sold for me. All right. Now take a look at the chart here. Here's August 25th. It got taken off today. Keep an eye on this IV rank line right here, this blue line, and the stock price as I slide along and count the days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 days, and my position got taken off. What did you notice? IV rank was at 73, right? It dropped a little bit, got as high as, what is this? It got to 100%. Okay, so it went against me as far as volatility wise, but yet I was still in my standard, my Golden Gecko range for my prices to be correct. Remember, because remember I sold the it had to stay above $32 and below $45. All right. Yeah, it never broke above $45 and it never got below $32, right? So, and look what happened today. vol just collapsed after the Alibaba thing, and that's where I made all my money. I could have made more, you know, because vol collapsed. I mean, from 100 down to 49. All right, so I pretty much would have made this. Probably would have turned out well. Remember now, my expiration date is in October, so basically 18 days into the trade. All right, where is it? 18 days into the trade, I made my 50%. You got to get out, manage your winners, and then you can just redeploy in something else. What could you redeploy in? Well, that's the benefit of the grid page, right? If you go to the grid page, now where can I use that capital? Go to your notables, go to your filter, hide your earnings, and go to 50%, and there you go. Sort by IV rank, volatility. These are everything above 50% IV rank that you could sell as long as you can collect about 19.8% of the expected move. Okay, and if it's liquid. So I did want to share with you that. I thought that was very important on how you can use your little cheat sheet charts. Here's your cheat sheet. Okay, and you can also see where what you should be doing. So under this slide right here, because IV rank was at 75, I did do it one standard deviation away strangle, you know, and I was able to collect 20% or more of the expected move of YHOO, and that's exactly what happened with the trade there. So I wanted to cover that with you folks as well. Now, I'm trying to figure out if I forgot anything, but that's the main thing I wanted to cover on what I look for in a trade and why we're looking at vol collapse. As far as our market update today, I'm not too sure if you watched the last call, but Slimmy said exactly. Remember how we talked about this breakout right here? I mean, how narrow it's getting? Well, if you look at what Slimmy said today, he said he sees the market going down a little bit, but he says if he sees it break 1970 or 1979 on the SPX, which is basically 197.9, which is right around, well, geez, right around here, 197 point, here. So, basically, if he sees it go below this Bollinger Band, he's a little short now, okay? If he sees it go below this Bollinger Band, he's going to increase his short position, meaning short more shares of the SPX. All right. Why? Because basically, remember what I told you? He's guessing that, or he's betting on that. If this tends to drop this way and below this Bollinger Band line, okay, and actually this Bollinger Band line is 2 standard deviations at this present time. So if it moves past this and goes below this 198 or 1980 on the SPX or 198 for the SPY, he's going to accelerate his short position on the SPY. All right, and I think he's going to buy puts. Okay, so for him to make money, he has to be right. The direction has to go down, but vol has to go up. All right. Well, in his case, he should be right because look how low volatility is. Now, for us, what we want is when we see this happening, we want volatility to rise like this. Remember how before? And we can start selling premium. Now, because a lot of my positions came off today because of expiration, and I have a bunch. I think I put on another post that it pretty much got held to expiration, and they're gonna close for max profit. I think I put that on today's post. My last post for today when I updated that yeah. Okay, these are pretty much all my other positions closed for max profit. They're closing for max profit. XRT, TZA, TLT, and I have a golden gecko in the spiders that's going to close again as well. PBR is doing great for me as well. So the concept works, guys. You just gotta practice and just put in the time. It doesn't take long. I'm doing these updates in 15 minutes or less. You can put on the same type of trades in 15 minutes or less. Now, One thing I might try, and I haven't tested this, all right, but it was just based on today's market measure. And I'm not recommending you do this at all. I'm just letting you know what I'm looking at, all right? Today's market measure was on straddles and strangles, where straddles, at the money straddles, when it was high IB rank, did really, really, really well. It just blew away Tom. It's messing with Tom's head. But just for kicks, I wanted to see what opportunities were out there, right? So let me show you what I was looking at. Here's Doe. Look, EWZ has 100% IB rank. It can't get any higher than that. Now, what an at the money straddle is, let me show you what that is. You can take I'll go to strangle, right? And I'll just go like this, 45 days like we normally do. But what a strangle is basically you're betting that the price will hardly move. So what you do is you see where it says widths, and just so you can see what it is. I'm not going to do it this way because I'm going to buy the wings as well, but bring in the strikes close, really close, almost right on top of each other, pretty much at the money straddle. So once I see it right on top, I'll do one wider, okay, like this. Click one time and it's Y. So look, basically I only have a 58% chance of being right. All right, I'll click on the leg. Each position has, look at the chance of being right. Now, the reason why, if you watch the market measure, the reason why it works is because you're able to collect so much premium. Okay, so what? Meaning, look, this is a bet that the call bet is betting it'll stay below $49. This put bet is staying going to be above $47 right here. So why is it that the profit margin is so wide way out here? Look where your break-even points are. As long as the price of EWZ winds up being greater than $44.02, but less than $51.98, you will make the max profit of $298 per contract. Actually, that times this by 100 because one contract is 100 shares. That's $2,980. Okay, but of course your risk is unlimited. So to mitigate that risk, if you're learning how to use Doe and we want to buy these two standard deviation wings, just make sure you see this 28 days here. Watch, grab a put, and you're gonna drag it down. Okay, and we know that we want. Oh crap! I just wait, hold on. I screwed that up, didn't I? I think we did October, right? So we're gonna grab it down to the October expiration date, and we're gonna put it to right that blue two standard deviation and let go. Okay, so as you can see, the expiration date for this green position right here is the same. Now grab the call, drag it out to October as well. It's right there, so October's highlighted, and right around this blue line and let go. Okay, look, now I just created a golden gecko. So now I can still collect $290 or $2.90 per contract. One contract is 100 shares, so I can make $290. But my risk is significantly reduced. The most I can lose is $610. Okay. What I don't like about this was this has that teardrop, teardrop, which means it's not very liquid, meaning the bid-ask spread is 9 cents. So if I sell something at the bid, it's got to collapse by at least 9 cents for you to make any money. If I click on the leg, all right, those are my probability of being out of the money for the call and the put. But I could make $290. So I'm considering playing with this on Monday. Oh, by the way, if you want to know what these numbers here mean, this 2 means my call and put are 2 strikes apart. The width between here and here is 2 strikes, okay, or $2, basically 2 strikes, okay. Now the width between here, this call and this call is 9 strikes. The thing from here and here is 9 strikes. Assuming that the strikes are $1 apart, then it'd be $9. But in this case, it might be, a little bit broken up. It might be half strikes, 47.50, then 47, then 46.50, then 45, whatever. But it's 9 strikes away. That's all these numbers mean. All right. So anyway, that's something I might play with, but I just kind of wanted to wrap up what that market measure was about. If you missed it today, and that's this one, straddles and strangles. I'm not going to post it on the forum yet because they're going to do another study. But the reason why is if you took a look, I'm going to flash forward to the end. Low IV, look, Straddles versus strangles. A golden gecko is pretty much a strangle.